Welcome to The Explainer. So, you ever wonder how professional investors really build wealth over time? Well, it's not some kind of magic, and it's definitely not a secret they keep locked away. Today, we're going to break down their exact playbook for investment and portfolio management. A lot of people look at the stock market and all they see is a giant casino, a huge, high stakes game of chance. But here's the thing, for the pros, it's not a gamble at all, it's a disciplined science. They aren't just placing bets, they're making calculated, strategic moves. And that's exactly what we're going to do in the next few minutes. We're going to take what's basically an entire MBA course on finance and distill it down into a simple, practical framework, something that can really help you think about your own financial future. Okay, so first things first. Before you even think about putting a single dollar into the market, you absolutely have to understand the huge difference between investing and speculating. I mean, they might look kind of similar on the surface, but trust me, they are completely different games. So, what even is an investment, really? At its heart, it's all about committing your funds with the clear expectation that you'll get a positive return over a long period. You're either looking for some steady income or you want that initial capital to grow. The key words here, patience and growth. Let's think of it this way. An investor is kind of like a farmer, right? They're carefully planting seeds, nurturing them, all for a big harvest way down the road. They are focused on the fundamental health of the company. A speculator, they're trying to catch lightning in a bottle, betting on wild short-term price swings, and often taking on massive risks for that quick payoff. All right, so how do you actually start investing like a pro? Well, it's got nothing to do with having a crystal ball. It is all about having a process. And that process has 5 very clear steps. This right here is the heart of the entire playbook. And notice this, it's a cycle. It's not a set it and forget it kind of thing. It all starts with you defining your personal investment policy. What are your goals? How much risk can you stomach? From there, you analyze potential assets, you build your portfolio, and then, and this is the really crucial part, you are constantly reviewing and rebalancing it based on how it performs. Now we're at step 2, security analysis. I want you to think of yourself as a scout for a professional sports team. Your job is to find the star players, the absolute best assets for your portfolio. And in the investing world, there are 2 main schools of thought for scouting that talent. The first approach is what's called fundamental analysis. This is the classic playbook for long-term value investors. Think Warren Buffett. It's all about being a detective and figuring out what a company is truly worth, its intrinsic value. That means you've got to look past the day-to-day market noise and really dig into the company's financial health and the economy around it. Analysts using this method have a top-down approach called the EIC framework. They start big with the economy. Is GDP growing? What's going on with inflation and interest rates? See, a healthy, growing economy is like a rising tide that lifts all boats. It just creates a much better environment for the stock market to do well. Okay, next, they zoom in a bit to the specific industry. Is it a young, high-growth industry like, say, AI? Or is it in a more mature or maybe even declining stage? They're looking at the competitive landscape and even how the government feels about that particular sector. And finally, they get super granular. They get right down to analyzing the company itself. This means they're poring over financial statements, checking out earnings reports, looking at debt levels, basically how the company is financing itself. They even look at the quality of the leadership team. Okay, now for that second approach, technical analysis. This school of thought couldn't care less about a company's earnings reports or who the CEO is. Nope, it's built on one core idea, that market prices move in predictable patterns or trends. The core belief here is that all that fundamental stuff, everything from earnings to economic news, is already baked into a stock's price. So instead of reading financial statements, these folks read charts. They're looking for patterns in price and trading volume that might give them a hint about where things are headed. This is a big-time tool for short-term traders who are all about market psychology and momentum. All right, so it doesn't matter which approach you lean towards, every single investment carries risk. And the key isn't to somehow avoid risk entirely. That's just not possible. The key is to understand it. You've got to know the different kinds of risk you're up against before you can even begin to manage them. An investment's total risk is really just 2 different parts put together. First up, you've got systematic risk. You can also call it market risk. This is the stuff that affects the entire market, things like interest rates changing, a war, or a recession. Then you've got unsystematic risk, which is specific to just one company or one industry, like a factory strike or a hot new competitor showing up.
So here's the most important takeaway from that. You can't really dodge that systematic, market-wide risk. But that company-specific risk, that unsystematic stuff, you can dramatically reduce it through something called diversification. It's that classic advice you always hear. Don't put all your eggs in one basket.
So let's bring this all home. Remember that sports team analogy we used? Well, building your portfolio is exactly like building a championship team. It's a real hands-on process of scouting, selecting, and then actively managing your players. You start by scouting your players, using either fundamental or technical analysis to pick your assets. Then you decide how much playing time each of them gets. That's your asset allocation. And this is so important. You don't just set it up and then walk away. You have to manage the roster, making trades and adjustments all based on performance. When you strip away all the jargon and the complex charts, professional investing really boils down to this one simple, powerful truth. Every single decision you make is a trade-off between time and risk. How long are you willing to wait, and how much uncertainty are you willing to handle? So there you have it. That's the professional's playbook for investing. It's not about getting lucky. It's about having a process, a discipline. And just understanding these concepts is the first and honestly the most critical step you can take toward making smarter decisions for your financial future. So now that you know the playbook, what's your first